So imagine walking into a car dealership today, um, finding a vehicle you really like, and just slapping down $35,000 in cold, hard cash.
Yeah, and watching the dealer actually look disappointed.
Right. It sounds completely counterintuitive, like you are handing them guaranteed money. But today, if you try to pay for major purchases with, money you actually have in the bank, they will look at you like you have three heads.
Oh, absolutely. Because it completely disrupts their entire business model. The dealership often generates a way more significant portion of their profit on the actual financing agreement itself.
Wow, really? So not the car.
Exactly. I mean, the interest you pay over 5 to 7 years makes them more money than they make on the actual metal and rubber of the vehicle.
Ooh,
So financing isn't just a convenience they offer you, it is literally the product they were selling.
that is just wild to think about. Well, welcome to the deep dive. Our mission for this session is tackling consumer debt, and we're pulling from a really comprehensive text on financial management to give you a shortcut to reclaiming your disposable income.
It's such an important topic.
It really is. But to actually map out a way to get out of debt, we first have to understand the environment we are operating in. We are living in a culture where owing money is just the default setting.
Yeah, the statistics from the source material, which focus specifically on Australia, paint a very stark picture of this reality. At this very moment, 38% of people are carrying active credit card debt.
38%. That's huge.
And it is not just an issue of older generations relying on traditional credit either. 22% of young Australians are actively entangled in buy now, pay later schemes.
Right, the whole, pay in four model.
Mhm.
And when you average out mortgages, personal loans, and credit lines, the average Australian is carrying over $200,000 in debt at any given time.
Wow.
We are talking about an entire economy that literally runs on borrowed money.
Which is why normalizing that feeling of overwhelm is crucial before we even start talking about strategies. You are operating in a system mathematically engineered to encourage continuous borrowing.
So it's not a character flaw.
Not at all.
Yeah.
So if you are carrying that weight, understanding that it is a systemic design rather than just a personal failure, well, that's the first step to dismantling it.
I love that. Okay, so if the system is designed to keep us on the hook, we need an aggressive strategy to cut the line. And the text outlines two major contrasting methods for eliminating consumer debt. The first is purely analytical. We'll call it the math, but it's widely known as the avalanche method.
Right, the avalanche method. This operates on a single, uncompromising principle, which is minimizing the overall cost of the money you have borrowed.
Okay, how does that work in practice?
Well, after making the mandatory minimum payments across all of your accounts, you take every single available spare dollar and direct it exclusively toward the debt carrying the highest interest rate percentage.
So the actual dollar amount of the balance doesn't matter at all in this scenario. Like big or small, it doesn't matter.
Not one bit. You are entirely focused on the percentage sign. The reason for this comes down to the concept of the cost of capital.
The cost of capital. Okay, unpack that for us.
Sure, so every dollar you borrow has a rental price attached to it, which is the interest rate. A dollar rented at a 6% interest rate is inherently more destructive to your wealth than a dollar rented at 2%.
The source material uses a specific mathematical comparison here that honestly, it trips a lot of people up. It asks you to imagine holding two different loans simultaneously.
Yeah, that's a great example.
Right, so loan A is a massive $10,000 balance, but it only carries a 1% interest rate. And loan B is a tiny $1,000 balance, but it carries a 2% interest rate.
And the avalanche method dictates you absolutely must attack the $1,000 loan first.
See, I want to break down the mechanics of why that works, because intuitively, the $10,000 loan feels like the bigger threat.
It does feel that way, yeah.
Right, because 1% of $10,000 is $100 in interest. 2% of the $1,000 loan is only $20. So I am physically paying more cash out of pocket every month to service the big loan. Why wouldn't I attack the source of the biggest cash drain?
It is a brilliant question, and it is the exact trap the system relies on. You have to separate the total volume of interest from the actual price of the individual dollars.
Okay, the price of the dollars.
Yeah, think of it like buying apples. If you buy 1,000 apples for $2 each and 10,000 apples for $1 each, your biggest bill is obviously the 10,000 apples.
Right, because you bought way more of them.
Exactly. But the $2 apples are still the bad deal. The avalanche method isn't about the size of the bill. It's about eliminating the most expensive dollars from your life as quickly as possible. Every dollar in that smaller loan is working twice as hard against you as the dollars in the larger loan.
Oh, wow. Okay, that makes total sense. You are systematically neutralizing the most aggressive threats to your wealth first.
Precisely.
And the text points out how crucial this is when dealing with high-interest credit cards because minimum payments are formulated to keep you trapped. Paying just the minimum on a 20% credit card is, well, it's like running on a treadmill where someone else controls the speed dial.
That is a perfect analogy.
Right. Like, no matter how consistently you run, the belt keeps speeding up through compounding interest. The avalanche is how you reach over and hit the emergency stop button on the fastest treadmills first.
Mathematically, there is no debate. The avalanche is the most efficient way to reduce your overall interest expenses and reach a net zero balance.
Okay, I get the math and I see the efficiency. But I have to look at this realistically, and frankly, I struggle with this approach.
Why is that?
Well, humans are not calculators. If my biggest, highest interest debt is a massive $20,000 credit card bill, I might be grinding away, throwing every spare cent at it for 2 or 3 years before I finally clear it.
Yeah, it takes time.
And I know human behavior. I know myself. Going 3 years without the satisfaction of actually crossing a single loan off my list, I would probably quit after month 4. Is the avalanche method just reserved for people with flawless financial discipline?
You are hitting on the fundamental flaw of purely mathematical frameworks. They demand delayed gratification.
Yeah, big time.
You are doing the optimal thing for your long-term wealth, but your brain is being starved of the dopamine hits that come from visible, incremental progress.
Which brings us directly to the counter strategy. If the avalanche is about pure math, the snowball method is designed entirely around human psychology. It acknowledges that if debt were just a math problem, nobody would be in it. Getting out of debt is fundamentally a behavioral challenge.
Absolutely. The mechanics of the snowball method actively rebel against the cost of capital. You still pay the minimums on everything to keep the accounts current, of course.
Right, you can't just ignore the other bills.
No, never.
Hmm.
But you direct all your aggressive overpayments to the account with the smallest overall balance, completely ignoring the interest rates.
So, returning to our earlier example with the $10,000 loan and the $1,000 loan. Under the snowball method, even if the $1,000 loan had a 0% interest rate and the big loan was charging 20%, you still attack the $1,000 loan first.
You do. The sole objective is momentum.
And for someone feeling suffocated by their financial situation, actually seeing an account balance hit 0, receiving that closure letter from the bank, it provides a massive psychological win.
It really does.
And it requires 0 financial literacy. You don't need to calculate amortization schedules or compare percentage points. You just look at your statements, find the smallest number, and destroy it.
But the trade-off is that you are actively choosing to pay a premium for that motivation.
Right, because of the math.
Exactly. While you are celebrating the victory of clearing a small, low-interest loan, your massive 20% credit card balance is compounding in the background. Choosing the snowball method guarantees that your journey out of debt will take longer and you will hand over more total dollars to the banking system in interest.
You are literally buying motivation at the cost of mathematical efficiency.
You are.
But honestly, for someone paralyzed by the anxiety of their situation, paying that premium might be the only mechanism that actually gets them to take action. If the choice is paying a little more interest over time or staying frozen and doing nothing, the snowball wins every time.
I agree. But whether you lean toward the analytical efficiency of the avalanche or the behavioral momentum of the snowball, both strategies share a glaring operational requirement.
Which is?
They both assume you have extra funds to throw at the debt.
Ah, yes. That is the immovable object in personal finance. The text says to direct your spare funds at the principal. But what if there are no spare funds? The people who most desperately need these strategies are usually the ones without extra cash hiding in their accounts.
And this leads us into the territory of budgeting, which mathematically is the solution to finding hidden funds. But our sources highlight a significant issue with the concept of a budget. The very word triggers a restriction mindset.
Oh, totally. It feels like an impending punishment. When you are already overwhelmed by past financial decisions, sitting down to build a complicated, restrictive spreadsheet just adds another layer of systemic overwhelm.
It's too much for a lot of people.
Yeah, many people simply don't have the bandwidth to maintain a ledger of every cent they spend.
Right, which is why, instead of a formal budget, the text advocates for informal savings. It is a much lower barrier to entry.
Informal savings. I like the sound of that.
Yeah, we intuitively know where our financial leaks are. without needing an app to tell us. It might be the 3 streaming services we forget to watch, or spending $15 a day on a mediocre sandwich near the office because we didn't meal prep.
I love the meal prep example because it's tangible. Let's say you decide to bring your lunch to work and you suddenly free up $50 a week. Here is the critical mechanism where most people fail, though. Identifying the savings is useless if you don't redirect the capital.
That is the crucial step. If you don't immediately route that $50 to your chosen debt strategy, it will simply be absorbed by lifestyle creep.
Oh, for sure. You'll just spend it somewhere else.
You'll end up spending it on a nicer dinner on the weekend, and your debt remains unchanged. The moment you cancel the subscription or skip the sandwich purchase, you must actively transfer that exact dollar amount to the principal of your debt.
It demands an embrace of short-term discomfort to accelerate your long-term freedom. But maintaining that discipline is incredibly difficult, which is why the text introduces a profound psychological framework for reframing what debt actually represents. We naturally think of a credit card bill as a problem for next month, but the source frames debt as future income that you have already spent.
It's a huge mindset shift. When you carry a balance, you are actively degrading your future disposable income. The text uses an $80 a week repayment as an example.
Okay, let's walk through that.
When considering a new purchase on credit, the reframe requires asking yourself a specific question. Is this item I am holding right now worth earning $80 less next week?
Wow, that $80 a week isn't yours anymore. You will wake up, you will commute, you will work the hours, and you will earn the money. But the capital already belongs to a financial institution. You are literally working to service past decisions.
And if that $80 wasn't legally bound to a credit card company, the utility of that money completely changes.
Because it's yours again.
Right. It could be establishing an emergency fund to insulate you from future debt. It could be compounding in an investment account. Or, as the text practically notes, it could be funding a holiday.
You are robbing your future self of a vacation to pay for a dinner you ate 6 months ago. When you internalize that your future labor has already been sold, the emotional weight of swiping a credit card changes entirely.
So we have established a framework for consumer debt, like credit cards, personal loans, vehicle financing. But this introduces a massive caveat when we look at the largest debt most individuals will ever carry, a mortgage.
I was just thinking about this. If the Avalanche and Snowball are so effective at crushing debt, why wouldn't I take my $400,000 mortgage and just plug it into the same strategy?
The sources place a massive asterisk next to mortgages, specifically advising against applying Snowball or Avalanche mechanics if the mortgage balance exceeds $120,000.
Wait, really?
Yeah, the architectural design of a mortgage is fundamentally different from consumer debt.
How does the architecture change the strategy? Debt is still debt, isn't it?
It comes down to amortization. Australian mortgages are predominantly structured as 30-year terms, and they are intentionally designed by banks to stretch the repayment over 3 decades because the interest is front-loaded.
Front-loaded, meaning you pay the interest first.
Exactly. In the early years of a standard mortgage, the vast majority of your monthly payment goes purely toward the interest, with only a fraction touching the principal.
So if I try to route my extra sandwich money into a $400,000 mortgage to create a snowball effect, what actually happens?
The mortgage will simply absorb your extra payments without yielding any psychological momentum, or significantly freeing up your monthly cash flow in a time frame that benefits your immediate consumer debt strategy.
Ah, I see.
Yeah, throwing small extra payments at a massive front-loaded interest structure while you still have a high-interest credit card balance is incredibly inefficient.
But the goal is still to beat the bank. We don't want to pay front-loaded interest for 30 years. If we aren't using the Avalanche or Snowball for the house, what is the countermeasure?
Well, the most effective countermeasure doesn't require finding extra funds at all.
Yeah.
It relies entirely on understanding how the bank calculates the interest and altering your payment frequency to disrupt that calculation.
I always assumed mortgage interest was calculated monthly, simply because my statement arrives once a month. But the text highlights that this assumption costs people hundreds of thousands of dollars.
Most people make that assumption. But behind the scenes, mortgage interest is calculated daily.
Daily.
Daily. If you owe $400,000 on day 1 of the month, the bank calculates a day's worth of interest on that full amount. They do it again on day 2, day 3, all the way to day 30 when you finally make your monthly payment.
Oh, man. So by waiting 30 days to make one large payment, I am allowing the maximum possible volume of interest to accrue against my highest possible balance. My money is just sitting in a checking account doing nothing, while the bank's meter is running every 24 hours.
Precisely. The strategy to dismantle this is incredibly simple, though. You take your exact monthly payment, cut it in half, and pay it fortnightly or twice a month.
Let's track the math on that. If I pay half my mortgage on day 15, the principal balance drops right in the middle of the month. So for days 16 through 30, the bank is forced to calculate its daily interest on a smaller number.
You got it. You are actively interrupting the compounding cycle. Without increasing your overall financial burden, you force more of your own money to strike the principal balance rather than being vaporized by the bank's interest calculations.
That is brilliant. Just by shifting the logistical timing of the transfer, you can shave years, sometimes decades, off a 30-year loan. It might take a minor administrative effort to align your mortgage deductions with your pay cycles, but the return on that single phone call to your bank is astronomical.
It is the ultimate leverage of mechanics over sheer financial force.
We have unpacked a really dense landscape of financial strategy today, but the core takeaway for you listening right now is that you have agency in how you dismantle the debt system you find yourself in. If you are deeply analytical and motivated by efficiency, well, the Avalanche method gives you the mathematical roadmap to minimize the cost of your capital.
But if you know that you need to see tangible, rapid progress to stay engaged, the snowball method gives you the psychological momentum to keep fighting, even if it costs a bit more in the long run.
The ultimate objective remains the same, regardless of the path you choose: eliminating the burden of consumer debt to reclaim your future disposable income. It is about untethering yourself from past purchases so your money can actually work for your future.
And reflecting on that concept of debt as future time already spent, consider this thought experiment. If every dollar you currently owe to a financial institution is a contract forcing your future self to work for free, what happens when that contract is burned?
That is a powerful image.
Right. If you operated with a completely blank slate, owing absolutely nothing to anyone, how would your career ambitions change? How would your tolerance for risk shift? And how would you redefine what success actually looks like for you?
When you don't owe the system anything, you get to design your own rules. Thank you for joining us for this deep dive. Keep questioning the financial mechanics around you, utilize the strategies that fit your behavior, and take control of your financial narrative. We'll see you next time.